All right, well, I think we better get started. Give me a sign if you can't hear me or if my computer freezes up. But thank you all for coming. So I'm a Ziegler from University of Queensland, and I'm convening today's Financial Geography Research Group Seminar that's hosted by the Regional Studies Association. This is the 6th out of 6 in our current seminar series. So before we get on to Amy's presentation, I'd just like to thank Derek and Martin and Karen and the rest of the gang from the FinGeo network. And I would also like to thank Alex from the Regional Studies Association, as well as my co-host, Fenghua Pan from Beijing Normal University. It's been a real pleasure hosting a series of really interesting talks on financial geographies and really seeing the diversity of research topics that constitute financial geography in 2021. So today we're lucky enough to have Dr. Amy Horton from University College London, who will be talking to us about care and financial fragility. Amy is a lecturer in economic geography and a degree tutor in the economics and geography BSc. Her principal research interest is in the interactions between finance, labor, and care, and Amy holds a bachelor's degree from Oxford University, a master's from King's College London, and a PhD from Queen Mary. And her current project is looking at the financial impact of COVID-19 on the UK home care sector, the implications for business and the workforce. So without further ado, thank you very much, Amy. Sorry, just some housekeeping. You are being recorded, and the recording will be stored for Giver, and immediately turn your camera on so she can see you. Thanks, Amy.
Thank you very much, Thomas. Let me just open up my slides here. There we go. Hopefully everyone can see that. Thomas, can you give me a nod if that's good? Yeah, perfect. Okay, thank you. So yeah, thanks very much for that introduction, Thomas, and everyone for attending today. It's a real privilege to speak to such a lively network. And I've been lucky enough in the past to attend a workshop by this network on finance, geography and sustainability before the AAG in 2017, and the first financial geography summer school the following year back in those pre-COVID times. And I've really been enjoying the online seminar series. So thanks to everyone's contributions to that. I'm conscious that this is a global network, but my empirical focus is on the UK. But I hope that my arguments will be interesting to you as an international audience. And I'm really looking forward to your comments and questions afterwards. So to give you a sense of the structure of my talk, I'm going to start by briefly setting out a theoretical framework that combines insights from feminist economic geography with critiques of the financialization of real estate assets and the built environment. I'll then outline the empirical focus, which is care homes for people aged 65 years and over in the UK. So care homes are institutions here that provide support for daily living and in some cases, nursing care. So I'll briefly explain how they're financed, funded and staffed, and then I'll set out my research methods. So in terms of the kind of key arguments, my analysis suggests that specific forms of investment are transforming landscapes of care. So in some places we see disinvestment and the development of care deserts where people can't access the care that they need. But in wealthier regions, we're finding the production of a new built environment for care. And this new built environment is shaped by the interests of financial investors in a number of ways. One key concern has been to render care homes' property assets more liquid. So in order to make those property assets more calculable and profitable, investors have sought to standardize the properties. And these standardized property designs, I'll argue, impose more labor on those who work and live in these spaces. So that process involves a transfer of labor from investors to care workers and care home residents. And I think this goes beyond understandings of financialization as intensifying demands on workers through the labour process, we have certainly seen that in care homes where investors have tried to reduce staffing levels and so on. But here I'm focusing on the labour that's associated with assetisation, that is the transformation of something into a revenue generating and tradable resource, as Keen Birch has put it. So the labour that's required to work with assetised space is partially transferred from investors to care staff. After that, I'm going to say a bit about a new collaborative project that focuses on the impacts of COVID-19, which of course have been particularly devastating for residents and staff of many care homes. So our research is examining the financial impacts of COVID-19 on care homes and the implications for businesses and the workforce. The pandemic, I think, has the potential to trigger either a reorientation and reform of care and support, or to intensify inequalities and financial fragility at individual, corporate, and systemic scales. Understanding the relationships between household, firm, and macroeconomic financial vulnerability is, of course, a key concern for financial geographers. And I'll conclude with a bunch of suggestions for further research and theorizing of financial geography. So we're all familiar with the kind of intensive, though very uneven investment that's been going on in real estate assets, and how that's driven efforts to release capital from the built environment into circulation. Conventionally, trading in property assets has been complicated by the difficulty of valuing specific properties. Sorry, Thomas, you've kind of lit up. Are you trying to communicate something to me? No? Okay, just checking that nothing's gone wrong with the technical stuff and you can hear me. So yeah, as I was saying, conventionally, trading in property assets has been complicated by how difficult it is to value specific properties. Because property assets are characterized by their unique geographical locations, built forms, and local markets, they've tended to be fundamentally incommensurable. And Gotham's work has been really helpful in this regard for me. So pricing and realizing markets for such heterogeneous assets involves extensive work. And financial geographers have studied how investors, governments, and other actors have worked to financialize real estate or render assets more liquid, that is, more quantifiable, comparable, and tradable. So one strategy to do that is to define and standardize real estate developments themselves, or put bluntly, to quote Willis, form follows finance. Now, it's obviously not that simple a process, but there's the kind of idea of that influence happening. And urban scholars have shown how investor expectations have come to exert a growing influence over the form of urban development. So financial requirements can be translated into physical form through an institutional specification for building design, as Crosby and Henenbury have written. And this has been studied in relation to standardized redevelopment zones and commercial property, where it's resulted in what Waldron describes as a more homogeneous and commodified urban environment. Of course, this closer integration of real estate with financial markets contributes to several risks. So we might see volatility arising from speculation, high debt levels, and overaccumulation, all of which means that the kind of ultimate investors, including pension holders, will not face stable returns. And it also provides a shaky foundation for long-term planning for the urban environment and welfare services, including care homes, by governments, businesses, and households. Even outside periods of intense volatility and crisis, the financialization of the built environment can have detrimental effects. And Desiree Fields has looked at how these have played out, for example, in rental housing in different cities, where investment funds, debt costs, and expectations of profit have driven up rents and in some cases led to underinvestment in maintenance. So there's this reformatting of the built environment by finance, which can generate geographies of exclusion. But this work on the financialization of the built environment hasn't tended to engage very much with questions of labour. And I want to suggest that it can be highly generative for financial geographers to bring in insights from feminist economic geography and political economy, as a number of our colleagues have already been doing. So this scholarship draws our attention to the advancing financial frontier into the realm of care, or as it's often conceptualized, social reproduction, by which I mean the activities that regenerate life and labor power. So studies of financialized social reproduction often focus on household debt and unwaged labor. So for example, the work of Brian and colleagues on how the reproduction of labor at home becomes a source of surplus value via the interest that families are paying on household debt. And consumer debt and retail investments have, of course, ballooned in recent decades, as this figure partly shows. So there's lots of brilliant scholarship on the way that unpaid labour within the household and the community contributes to servicing debts and to meeting those returns on investment. For example, among microfinance borrowers or volunteers whose activities underlie social impact bonds. The implications of all this are unequal. Some people obviously benefit from asset-based welfare and rising asset prices, but for others, social reproduction can be depleted by the demands of debt and other financial obligations, as Brian and colleagues have explored. And indeed, in times of crisis, households are the shock absorber of last resort, as Jane Pollard has discussed in her work. So to give a contemporary example, the UK's Financial Conduct Authority conducts a financial lives survey, and it found a dramatic increase last year in rates of low financial resilience, which is defined as over-indebtedness, low savings, and low or erratic earnings. Caring responsibilities were one of the top 3 factors in households being unable to make their mortgage repayments and requesting a deferral. So how does financial resilience fit into a kind of broader landscape of thinking about fragility? Well, low financial resilience is viewed by the UK financial regulator as a characteristic of financial vulnerability, which the regulator has a duty to address. And a vulnerable customer, in their perspective, is someone who, due to their personal circumstances, is especially susceptible to harm, particularly when a firm is not acting with appropriate levels of care. So I think there's a kind of interesting mobilization of ideas of care within financial markets and regulation here. But critics have pointed out that this approach only addresses vulnerability at the individual, not systemic level. And we see a kind of similar regulatory gap in the treatment of organisations providing care, where there's been a light touch system of market oversight for private providers. So the regulator there doesn't have powers to influence public funding for care, prevent extractive business practices, or address low pay for care workers. So we have this kind of very partial approach to addressing financial vulnerability. And as that example of care homes shows, a lot of the activity of social reproduction takes place outside the household and the unpaid sphere in public institutions and the market. And there's been extensive financialization in these domains too, some of which I'll demonstrate in this talk. So all of these forms of financial vulnerability can contribute to a process of financial fragility, which is itself potentially culminating in financial instability or crisis. So on the slide, I've put these different ways in which the financialization of social reproduction contributes to financial fragility. Now, I recommend Gary Dimsky's work for kind of in-depth discussions of Minskian theories of financial fragility and instability. But clearly, high levels of corporate and household debt put many actors in a weak position to face the shock of the COVID-19 pandemic. And those starting conditions were the result of austerity and state-sanctioned financialization over recent decades. So a little bit about the empirical context now, and the significance of care homes from the perspective of financial and economic geography. So care homes in the UK are a major element of welfare provision. They are home to more than 400,000 people. They're also an extremely large employer. So if we include other types of care and support outside care homes, social care accounts for about 6% of jobs here. And that's even after the very high vacancy rate, which reflects that pay for care workers barely exceeds the legal minimum wage. The vast majority of care workers are women, and a higher than average proportion for the population are Black, Asian, and minority ethnic. So we have this kind of lower status workforce in care from devalued groups of workers. Social care in England has been means tested since the creation of the post-war welfare state. It's funded by a mix of local government funds and personal payments. So individuals with assets worth about $30,000 US are liable to pay towards their care. So whilst there is public funding going in to support others based on that means test, the vast majority of care homes are privately owned. Most of them are small and medium-sized enterprises, often family-run. But if we're looking at the biggest companies, then it's investment funds who have dominated their ownership since the 2000s, and in particular, private equity funds. So by 2011, chains owned by investment funds were responsible for 1 in 5 care home residents. By 2015, as the table shows, they owned 7 of the top 10 care companies. And the significance of these particular actors as owners is around the kind of different sources of financing and riskier business practices that they've introduced. So key practices of investment funds include selling off property assets, borrowing on capital markets rather than from banks, and loading care companies with much higher levels of debt. So my collaborator on the current project, the Centre for Health and the Public Interest, have done some fantastic analysis of kind of the flows of finance through care companies, and found that for the largest 18 private care companies, 15% of revenues are devoted to profit, rent, directors' remuneration, and interest. So that's more than double the rate in small and medium-sized enterprises. Under investment fund ownership, and with the additional strain of austerity, the sector has witnessed multiple crises, including the collapse of the 2 largest chains into insolvency within the last 15 years, one of which was among the largest debt restructurings in Europe, triggered by the 2008 financial crisis. So this presentation draws on analysis of corporate sources and material from property brokers, consultancies, and specialist sector press. And I also conducted 25 interviews with investors and industry advisors, care staff, and trade union officials. And the new project that we've mentioned is in collaboration with colleagues at Warwick Business School and an independent think tank, the Centre for Health and Public Interest, plus partners at the trade union Unison and the National Care Forum, which is a group of non-profit care homes. So this project involves an analysis of company accounts in which we're identifying which types of homes and places are most vulnerable to business failure. We're also conducting a survey and interviews with care staff and managers on the implications of financial pressures during the pandemic for care staff. So care homes have emerged as a kind of significant property investment. We had that initial phase of financialisation of care that really focused on cutting costs, including staffing costs, and growing a mass market of publicly funded residents. But these strategies became increasingly exhausted by minimum wage legislation that kind of put a floor undercutting staff costs, and austerity that undermined that mass publicly funded market. So in that context, care businesses' property assets assumed an even more central role. And key in this regard have been real estate investment trusts, or REITs, which are permitted under UK regulation since 2007 and more liberally since 2012. I'm sure many of you are familiar with REITs, but I'll just briefly explain their function and particular role in the care sector. So REITs own property portfolios and sell publicly traded shares to investors. Investors get dividends based on rental income, and often that's linked to quite long leases, so that's one of the attractions for investors. And they can also benefit from share price gains where real estate values rise. So they offer several significant benefits for shareholders. They enable highly liquid investment in a diversified property portfolio. They're required to pay out 90% of their rental income to investors, and they're not liable for capital gains or corporation tax. So we've had kind of strong returns to investors from REITs. And this has helped to overcome that kind of illiquidity of property assets that I was talking about previously. Of course, during crises, actors tend to have a stronger preference for liquidity, and that can make these types of tradable investments particularly attractive. So on this slide, you can see a number of logos from different REITs that operate internationally in the US, Spain, France, Japan, and elsewhere. So very interested to hear about your expertise on REITs in different contexts. So care homes in the UK are mostly quite old, often not purpose-built, and there is a big need for capital spending. REITs have a lower cost of capital than private equity, thanks to that huge demand for property investment, and more specialist teams to deal with care homes compared to the institutional investors. So in that context, REITs became the major investor in UK care homes by 2018. And care home real estate has been marketed as an alternative property investment alongside things like student accommodation and hotels. These sectors, it was suggested, can provide consistent counter-cyclical returns based on longer leases than those of other commercial tenants, with rents indexed to inflation or rising automatically in some cases. So to give one example, between 2014 and 2017, Target REIT, which is based in the tax haven of Jersey, offered investors a return of 35% from its care home portfolio. And REITs have three key roles. One of them is as a developer. In 2016, for example, the US-based REIT Welltower was the largest single developer of care homes in the UK. In addition to their role as developers, REITs have acquired existing care homes, and they're an increasingly significant landlord in the sector. This big growth you can see on the slide of the number of homes that they owned and tens of thousands of people living in their homes. So some REITs have focused on acquiring and building kind of prime properties in regions with a high proportion of privately paying clients. Others bought up chains with a national presence because the land prices in those kind of prime regions were simply too expensive. And we ended up with this quite diffuse geography of REIT-owned care homes. But one thing that stands out about REITs is that their rents tend to be 15 to 20% higher than other landlords on these kind of new developments. And they often have these upward-only rent reviews. So care homes renting from REITs are often paying a higher proportion of their revenues as rent than other care homes would be. And as well as acting as developers and landlords, REITs have played an important role as lenders to care operating company tenants or to finance leveraged buyouts of care chains by private equity firms. But some of these debts have proved unsustainable. So the example on the slide is for the private equity buyout of Four Seasons Care in 2012, when the REIT HCP provided £137 million of debt financing with this pretty high annual interest rate. And Four Seasons struggled under its huge debt burden. So in 2017, HCP REIT had to sell on that debt at a huge loss. So investor priorities contribute to the production of a specific built environment for care in financialized chains. And this happens in a number of ways. So it's encouraged, first of all, by investors categorizing care homes as a subsector of commercial real estate alongside hotels. And that categorization helps to make care homes comparable to other properties and calculable as investors. So we see it often in property industry publications, and it helps to reduce investors' sense of risk by offering an alternative use for this space as well. So one person told me, an investor, if profits fall too low in residential care, some of the homes, the newer Holiday Inn Express type unit, could be converted into low-end hotels or student accommodation. So space is standardized and made convertible. And the rationalization of space enables the maximization of returns from a larger number of residents. So another team of researchers found that market pressures in private homes can lead to less outdoor and shared spaces. And instead you've got this emphasis on the kind of individual room or bed. That can detract from concern for relationships between residents, staff, and the wider community. In these financialized homes, design also tends to follow abstract templates and not necessarily respond to the embodied needs of residents and the situated knowledge of staff. So one interviewee described to me a new facility that's been built by a company under private equity control. It had 4 wings, 15 people each. So this is a medium-sized care home, but quite a lot bigger than the kind of historic average. And they said that the homogeneity of design was disorientating for residents with dementia. So the staff had suggested that the wings could be painted different colours to help people orient themselves, but that suggestion was ignored. And the kind of search for economies of scale also kind of pulls against the interests of workers and residents. So one carer said to me, it's very hard in a 60-bed care home to get to know the people as well as in a 30-bed care homes. And larger care homes can place strains on caring relationships and that sense of community. They are associated with lower care quality in the kind of rankings given by the care regulator. And more recently, larger homes have also suffered from higher rates of COVID outbreaks. So while financialized providers have devoted resources to these upgrades, they've exerted strong downward pressure on labour costs. And we've seen a big wage differential emerge between the few public sector carers and those in the private sector. Obviously, those decisions can exacerbate staff turnover and shortages, which are extremely high in care, and require additional effort by staff and residents to form the relationships that underpin care. So overall, I'm arguing that in this context, extra labour is required by residents and workers to create a sense of place and home and care. And these are the contradictions that I'm trying to convey in the phrase liquid home in the title of my paper and transactions that came out earlier this year. So turning now to the kind of current situation of COVID-19. COVID-19 has obviously taken a devastating toll on older people and especially care home residents in many countries. In the UK, excess mortality has contributed to reduced rates of occupancy in care homes, and concern about exposure to the virus or limits on visitors have also deterred some prospective new residents, particularly people who pay for their own care and might have greater resources to purchase alternatives. So those are the groups that private operators have increasingly relied on before the pandemic, and are now finding to be a less stable market. Some care homes have also had to close sections of their services for operational reasons, and overall these factors have reduced occupancy rates from 86% pre-COVID to 77% in March 2021. So a huge drop in care home occupancy, and they're not expected to recover until mid-2022 at the earliest. So of course that has serious implications for care homes' revenues. At the same time, care homes have been hit by a range of increased costs, including for PPE and staffing to cover sickness, shielding and furlough, as well as the additional work of testing and supporting visitors. So the extent of these costs is, obviously highly politicized and disputed, but last November, a group of providers estimated that costs per place had increased on average by £5,000, so a significant bump, and overall surpluses among providers had fallen by 71% compared to end of March last year. So once we've got accounts through from financial year 2020-2021, we'll have a clearer picture of these costs and the complex geography of care homes' financial vulnerability, which has varied locally depending on wealth, government funding, COVID rates, staffing costs, and other factors. So we've seen these pressures on care homes, but actually the number of care home closures has decreased over the last year compared to pre-pandemic for several reasons. So one of those is public support. We've seen a range of grants made available. There's lots of concern about whether funds are actually getting through very bureaucratic processes, and austerity drained local authorities to the care frontline. New legislative proposals would actually allow bailouts of for-profit care homes for the first time. And that's a significant step, because before the government had really left crisis resolution to the care market and had kind of kept it very much at arm's length, more so than in other sectors. So alongside that public support, there's been a big increase in private sector debt, which we'll be releasing some estimates of. For example, one of the biggest care chains, HC1, recently announced a debt restructure in fact, a wider restructure with the closure of 4 care homes and plans to sell off 52 more, along with a £540 million debt refinancing with Welltower REIT. So I think there we're seeing that kind of retrenchment to the most profitable parts of care provision. And the other kind of key source of additional financing has been publicly supported debt. So in the UK, there's been the Coronavirus Business Interruption Loan Scheme, where the public British Business Bank kind of supports firms to access loans from lenders that they've accredited. The government pays the initial fees and the first year's interest, and offers partial guarantees in case of default. So there has been a lot more support for the care home sector, but there's also a big risk, I think, of greater financial fragility developing. Businesses are likely to struggle to repay if coronavirus continues to disrupt operations, and we see a continued shift away from residential towards other kinds of care, like home care. But the pandemic potentially offers opportunities for the reorientation and reform of care services. And there's been a range of alternative practices adopted by some local authorities and the devolved administrations in Scotland and Wales in particular. So key areas of practice and recommendation include, firstly, taking care homes into public ownership. That's been advocated by unions such as GMB when homes are being sold off by private providers. Secondly, restricting or more heavily regulating the finances and business practices of care homes. So that could involve using a licensing system or commissioning to limit debt levels or block the use of tax havens by care companies. And thirdly, there's been research and experimentation into alternative forms of financing and ownership, whether cooperative, public, and so on, by organisations like the New Economics Foundation and the Foundational Economy Collective of Researchers. So some of this practice reflects, at least partly, calls by some feminist economists and policy advocates for greater public spending on both social sites and services, so not only on the kind of physical infrastructure, but the labour as well, in order to promote well-being, long-term fiscal savings, wider sustainable economic activity, and decent work. And as they've argued, care work is essential work and low carbon, and so potentially part of a kind of feminist or caring Green New Deal, or an important part of it. But in England, local action is strongly constrained by central government policy, which continues to hinge on the conflicting concerns of, on the one hand, cost to the public purse, and on the other, the preservation of private property and inheritance. So the idea that the kind of central concern of care policy should be to protect people from having to sell their home to pay for care. But there's perhaps glimmers of hope in growing public attention to care, greater bargaining power of workers if staff shortages really bite deeper among COVID recovery, and the wider adoption of critiques of financialisation. So we've seen kind of some of the critiques that researchers have been developing taken up in Parliament or even in the right-wing press in a kind of limited fashion. So a few kind of ideas and things for further thought by way of conclusion. In analysing the treatment of care workers and care home residents during the pandemic, Bev Skeggs has used Akili Mbembe's work on necropolitics, which identifies how the legacies of colonialism, which designate which lives matter, are being reinvigorated and institutionalised in a political economy in which elites reap monetary gains. Death becomes a matter of calculation factored into profitability. So here her work is around kind of certain groups being designated surplus and disposable. And she argues that as the social contract fractures further, we're seeing the spread of corruption, conspiracy, and lack of accountability. And Bev Skeggs has dubbed the ways in which care homes have been run and governed a form of necro-speculation. That's obviously a world away from how investors characterise their activities in care. So funds are targeting care homes and other forms of care like retirement communities as an ESG investment, promising to save the health service money, offer energy efficient, carbon neutral development, and released housing for younger families in the broader housing market. So I think their development and impacts require critical scrutiny by economic and financial geographers. And there's also much work to be done in tracking the relations of financial fragility across different places and actors. So today I've briefly mentioned the Financial Lives Survey, which seems to be a kind of underutilised resource in economic geography. Our critiques can draw on a wealth of propositional thinking, for example, on the foundational economy, where scholars have argued that if firms are providing welfare critical foundational services, like retail banking or adult care, then they should be treated as in the public domain, regardless of ownership. Using, for example, social licensing to regulate and set standards, potentially as part of the provision of universal basic services. So that as an alternative to asset-based welfare and the financialisation of social reproduction. Some of that thinking and practice is the subject of an edited collection that Chris Harker and I are putting together with a range of brilliant contributors, which is due out next year. So I'll leave it there. Thank you so much for listening and looking forward to questions and comments.
Great. Well, thank you so much, Amy. It was fascinating. I'm sure all of us are pondering our own futures in a care facility at some stage. We've got some great questions in the chat, so I'll quickly summarize those, and then I might ask you to answer those first, and then we'll turn it to the floor. So I can kind of combine Michael and Karen's questions, which is basically, what are the differences between the private and public providers, and in terms of both in terms of the service and in terms of the actual employees?
So in terms of the employees, it's pretty clear that the terms and conditions are much better in the public sector, and the costs associated with that have been one of the kind of key drivers for increased outsourcing and privatization of care services. So under austerity, we've seen kind of the wholesale transfer of care provision in local areas to private providers, and that associated with the development of new care homes, so replacing the kind of older facilities, but at the same time staff being basically offered the option of redundancy or re-employment on much reduced terms. And unsurprisingly, that kind of encourages greater staff turnover and vacancy rates. In terms of the services, I think it's more complex. So I think there's a range of really valid critiques about sort of how care has been delivered historically, which is overly bureaucratic, impersonal, underfunded. So I don't at all want to romanticize the kind of public sector provision in general. But what I'm trying to suggest here is that sort of we might see lots of money going into the facilities in the case of private equity owned chains, but that doesn't necessarily increase the quality of care, and in fact it can actually be kind of undermining it if they're prioritizing the sort of calculability, profitability and marketability of care homes at the expense of what they're actually like as kind of places to live and work and provide care.
Thanks. The question from Jackie was, what ultimately wound up happening to the homes owned by chains that became insolvent?
So they've basically been, in some cases, the care homes have been shut down, and in other cases, they've had new managers take over to operate the homes and to own them. So, I think what we're seeing, though, is that sort of attraction of those assets has decreased, and that's where we're seeing care deserts emerge. So obviously investors can lose out when there's a massive debt restructuring, including the ultimate investors via pension funds and so on, but also the sort of availability of care across different areas can be jeopardized when the kind of profitability requirements increase, and then chains are left trying to kind of pay off debts and so on as far as they can.
So that leads me to David's question. And actually, I have an add-on, which was my own question, which is about aging. So the geography of aging tends to be exactly the opposite of the geography of wealth. People tend to leave places that are not economically prosperous, which means you would have a lot of older people in places that are less advantaged. So I guess adding that on to David's question about the geography of care, what does it look like?
So I think it's very complex because so much of the wealth is held by older people in the UK. But of course, we also have a geography of kind of towns and rural areas where there are a lot of older people without much wealth and without the kind of property assets that the investors are looking to come in and basically liquidate to pay for care fees and the wider hotel costs of staying in a premium care home. So there's different influences to do with the costs of land, the cost of labour. Like in London, finding care staff is extremely difficult. Obviously, land is extremely expensive. So I think we see the kind of development being focused around the kind of A roads, like the arterial roads in the southeast, where it's easy for people to go and visit, but it's not in the kind of most expensive locations. And I've also heard that REITs have been looking at kind of, parts of the country that they weren't so interested in at first. So I think, as I mentioned, there's this kind of diffuse geography of it, and it's certainly, it's not a straightforward picture. But the approach of the government is very much to kind of let the market get on with it, with a degree of oversight from local government that is grossly under-resourced to carry out that task in most cases.
Great. Well, we have about 10 minutes left. If others want to turn their camera on and maybe just ask the question directly, I'm sure you're all pondering the fate of your grandparents at this point.
I see David making a comment about Finimo. So I think in other countries outside Belgium, they have a presence in the care home sector. I know they've sort of expressed interest in some care chains in the UK, but it's tricky to keep track of kind of who's expanding or divesting their portfolios in different places. But it would be great to kind of see more comparative research on this model across different places. I know there is work that's gone on, but we haven't kind of joined it up very effectively.
Yeah, I just want to update that. Laura, who's also in the room, let me know that Cofinimo is indeed also investing in care homes in Belgium. So there's parallels there.
Thanks, Laura.
Hi, Amy. Thanks for that. It was so interesting. You mentioned in there, you might have mentioned already, but you said that 90% are kind of privately owned in the UK now. And I'm wondering, is there a sense of how much of that 90% is the kind of big private equity companies, and how much is that sort of small scale, single kind of family run business?
Hi, Caleb. Very nice to see you, because I've read your work and we've exchanged emails, but I've never actually met you. So hi. So it's in minority. I think it's about a fifth now that are owned by big investment funds. And so the vast majority are these much smaller operators. But whilst we see the kind of build-up of financial risk among the largest chains, there's also a lot of financial fragility in that small scale. So, typically those might be family-run businesses that are in a kind of converted residential house that isn't really set up to care for people with very acute impairments, which is increasingly the population of residential care, and where the business is dependent on having paid off any mortgage on that property. So I think that's a kind of non-renewable element of the sector. And if that starts to fail, or those business owners retire and aren't replaced, then that's a massive sort of source of vulnerability to the sector. And we will have some more analysis coming out of kind of how COVID is likely to have affected the different operators who haven't tended to be at the smaller scale very well kind of monitored or understood, despite their very important role in providing care. Thank you for your question.
I have sort of another question just off the top of my head. I'm wondering if Brexit might affect things in terms of I'm guessing that there are a large number of carers from Eastern Europe. So a large number of carers would be Polish and Hungarian, and presumably, who would be working for less than an NHS nurse would. So I'm wondering how that might be affected by Brexit, and maybe if these REITs had been exploiting that sort of window.
So yeah, Brexit is a big threat to the sector, and we're starting to get some data on a fall in the staff from the EU. Of course, there's staff from beyond the EU as well, who are a really important part of the workforce. Yeah, I'm not quite sure what you mean about kind of exploiting that window, though, Thomas.
In terms of, it was sort of a moment in time. I mean, there was only about a 20-year period when Britain had a population that was rapidly aging, B, a neoliberalizing system, C, an opening of carers from Eastern and Southern Europe who spoke English, and D, prior to Brexit.
Yeah, so obviously then they start to make amendments to the immigration regime depending on kind of the needs of business. So sort of senior care workers have been listed as a shortage occupation, as are nurses. So, you know, there's exceptions when people want to keep those global care chains flowing. But we've also seen, I think, some increase in the bargaining power of labour because of the vacancy rates. And so as part of that big debt restructuring by HC1 that I mentioned, they've said that they're going to raise the wages to £9 an hour. So, you know, the wages are going up, but at the same time, you know, where the business is heavily indebted or under strain from austerity, the capacity to pay those higher wages is somewhat constrained, or certainly requires a kind of big reorientation of the business model. And so I think that's another kind of potential source of financial fragility.
Yeah, thanks. There's a question from Claire. Do you want to ask your question, Claire?
Sure. Sorry, I wasn't sure if we were writing them or speaking them, so you can have both. Thanks so much for the paper. I found it really, really interesting. So I was wondering about when you were saying that care home residents and staff were kind of encouraged to produce this community feel in the space. Sense of place, home care were the examples that you were giving. I was just wondering if you had any more on that you could tell us about, because it seems really like a really kind of fruitful space to think through social reproduction in those spaces.
Yeah, thanks, Claire. I agree. It's a kind of critical part of understanding care, social reproduction, and care homes in the context of financialization. So it's true that, you know, often the kind of social aspects and relationships between carers and so on are part of the marketing approach of care chains. But also that people, you know, are people and they genuinely want those things to differing extent based on our personal preferences and so on. So I guess, you know, that happens through a range of activities depending on the sort of capacities and impairments of residents. And there's some great ethnographic work on the role of like activities coordinators in care homes or visits. And so much of this has been really constrained by COVID-19. So one aspect of the current project is to think about how does not being able to have relatives visit or go out for the day or do kind of group activities together, how does that increase the labour that's required of care workers? So that, you know, it's not necessarily about financialization in the COVID context, but I think we see this kind of reorganization of the priorities of care businesses when they are owned by investors. So I've got a colleague whose name suddenly escapes me because we only connected a couple of months ago, but she's done some fantastic work on kind of care homes and so on. So I can put you in touch if you're interested in learning more about that. Thanks very much for your question.
So there's a question from Maria Len about alternative housing. Do you want to ask your question, Marie?
Yeah, sure. So hi, and thank you for this nice presentation. For my thesis, I actually wish to work on alternative kind of housing for elderly people, but I was wondering how to control the risk of financialization of this new form of housing, because they actually appear because of financialization of care home, but how to avoid that just the same happens.
Excellent question. I'm very excited to hear about that emerging research. So please keep in touch about what you're doing. I mean, I guess there's certain models that wouldn't be attractive to investment funds because they are too small scale or because of the way that ownership is organized. So if you had a cooperative approach, then in theory, that could eventually be kind of sold into the private market and financialized. But if people were committed to that, then, you know, that could be somewhat protected. So, you know, you could look at the work of cooperatives like ECHO, there's one which is called ECCOO, although they're more common in the home care sector rather than residential care in the UK because of the kind of capital required for care homes. or as I mentioned, the foundational economy collectives, so people like Colin Haslam are doing work with the Welsh government to look at kind of how public pensions might be mobilised to provide finance for homes in the public sector, or that have a kind of much more stringent system of licensing and commissioning to make sure that the priorities of residents and staff and the community are at the heart of their operations rather than these extractive business practices. And internationally, there's all sorts of kind of different models of funding care, from social insurance schemes and so on. So I think I'm sure you'll find kind of rich examples to read about across different places.
Thank you.
Right. I think we probably have time for one more question. All right. Well, in the absence of another question, let's just thank Amy one more time. I think the abundance of questions we did have and the diversity of questions shows what an interesting topic it was, and very thoroughly researched. So we look forward to your papers, Amy. Thank you. For those of you that, sorry.
I was just saying thank you very much for inviting
yeah.
me to speak, and to everyone for your comments and questions, which really, really appreciate it.
Yeah, thanks to the audience as well for coming along, and thanks again, Amy. If you'd like to stick around, we have a wander.me link, which I'm posting now. So if you click on that link, you will see everybody in the room, and you can sort of go around and form your little circles and bubbles and have a virtual chat if you'd like to. If not, take care. Thanks for coming along to the FinGeo Seminar Series, and we hope to see you in a few weeks when the next announcement is regarding the next set of seminars. See you later.